Third quarter report for Netflix, forget the revenue, forget the profits. It's all about the subscribers. Right. And they crushed this number, adding just under 7 million new subscribers.
Chris, it was a great quarter for Netflix on this. Pretty much every metric they give guidance on, they beat and they give guidance, and they have a lot of transparency in their numbers, and it was extensive. Like you said, 7 million net subscribers versus 5 million expected. They added more than 1 million net additions of subscribers on the U.S. side and almost 6 million on the international side. Remember, it was just 3 months ago when investors were really concerned that the growth of Netflix had started to tailor off a little bit, and they came up a little bit short on the subscriber line. Clearly, this quarter, they knocked it out of the park. Streaming revenues were up 36%. Average paid membership numbers were up 25%, and that paid membership one is what they really are now going to focus on. And the average selling price is up 8%. So overall, really impressive quarter by the streaming content leader of the world.
The stock is up today, and year to date, yes, it's down from the highs of a few months ago, but year to date, it's up 80%. I mean, is it expensive? Well, is it because someone like me who is not a shareholder and has never been a shareholder, I look at that and I got to be honest, my gut instinct is, well, I can't buy it now.
Well, I added some to it earlier this year when the stock got knocked around after the last quarter when the stock had fallen 10-15%. I mean, when you think about this business, it's a $150 billion market cap in the global media landscape that they are playing in and competing in, and the success they are seeing, I think, with the leadership team of Reed Hastings, who owns about 1.5% of the business. They have extensive growth opportunities around the globe. Clearly, the U.S. is the slower growing market, so international is really where they're focusing on. And they're spending $8 to $12 billion per year on content that they are developing, and so much of that is turning into in-house content development. They have hundreds and hundreds of original programming now. They're going to spend up to $1 billion on an Albuquerque, New Mexico production studio over the next 10 years, where they're going to develop a lot of their individual content. Clearly, they are becoming a content and distribution king around the world, and they're starting to focus more and more on these individual markets around the world. So it's not just U.S. I look at that and I say, you know what? For a 1 to 2% of your portfolio, I think Netflix is well worth the addition in there.
Yeah, Jim Mueller was in the studio recently, and we talked about that acquisition of the studios in New Mexico. And just like you, he brought up their expansion, particularly in Europe. I think they have some new studios in Spain, or recently new studios in Spain. So it's really going above and beyond what I think some people had expected in terms of not just their global expansion, because they've proven that they can get subscribers around the world, but it's the production side of things and their ability now with a network of studios in the United States and out, that they're able to go to film producers, showrunners, et cetera, and say, well, wait a minute. If you're looking to go overseas, talk to us because we've got some options for you.
And that's really important, Chris, because over in the European Union, there are regulatory changes in play that at least 30% of eventually, at least 30% of your content of your library for a streaming service will have to be European focused and European produced. So they are going into those markets. It's also having an impact on what's happening competitively, because we saw Comcast go off after Sky aggressively and spend a lot of money for Sky, up to $40 billion for Sky to be able to get that distribution platform. So when I add it all together, yes, the free cash flow or lack of free cash flow has been a concern as they continue to spend more and more money. We did see this quarter their operating profit picture improve, and a lot of that was some timing. They have a lot of flexibility when it comes to how to manage these costs, and they've been doing that quite well. And they talked about that, and they've have some nice expectation for profitability next year, and their cash burn for next year is actually, they think now, will be flat to this year. So it's not going to worsen. That's good news for shareholders. They're going to continue to invest in these platforms. I think they will be able to continue to grow their subscriber base at a rapid clip, and certainly more rapid than some of the established players in there. And that's all good news for shareholders.
It's interesting to hear about the cash burn, because ahead of this earnings report, we saw analysts at places like Morgan Stanley and Goldman Sachs essentially cut their price target on Netflix, in part because of, yes, rising interest rates, but also perceived increased expenses. Because I think a lot of people just in a vacuum expected that, well, look, they're going to spend more on content next year than they did this year, because that's been the pattern for a while. Well,
and it probably will be. The nice thing, what we saw a little bit this quarter, and they talked about this on the conference call, is just to be able to manage these costs. They have some flexibility in how it's taking across the costs across their entire platform. That's a real advantage that Netflix brings as a streaming service. Their profit margins compared to the likes of Comcast, for example, are half. But Comcast's legacy costs are so heavy and their revenues are only growing in the single digits. And I own both Comcast and Netflix in my portfolio for different reasons. The cost structure is so different that Netflix long-term, when you look out 5-10 years, the profitability picture and the ramp for them is so much more impressive than the likes of some of the established players. I think that's really what subscribers are buying. So it's the ability to be able to grow the subscriber base, streaming revenues, spread those costs out by offering a product that is really superior in the marketplace that investors are excited about, and eventually that will show up on the cash flow line.
I assume you own shares of Comcast because you're from Pennsylvania, and I think that's a law in Pennsylvania that you have to own shares.
Yeah, the Roberts family, the arm of the Roberts family goes very long.
Hey, this is a minor thing, but it's just something I'm curious about with respect to Netflix. Where's the shop? Remember they had some headlines a year or so ago where it's like, oh, they had posted a job, because that was always, I shouldn't say always, but for a long time that was my thing with Netflix. Why they've got these successful shows that they are producing and they own. Why aren't they just making some gear? Why aren't they T-shirts, hats, mugs, etc.? HBO does a great job, not just with original programming, but of selling any Game of Thrones paraphernalia that you want to get your hands on. HBO is happy to sell that to you. Where's the shop?
Yeah, maybe they should talk to the Motley Fool. We have some pretty nice swag that they could learn a little bit from.
You know what? When the Motley Fool podcast swag shop is selling more, is up and running more quickly and selling more than the Netflix shop, that's my only point of concern with Netflix as a business.
You know, it is interesting from the marketing side, Chris, and they talked a little bit this on the call, and dialing back some of the marketing tactics and really letting the content speak. And I think that's important. I think it actually is a very big driving point for Netflix to grow their subscriber counts, which is they have the content library and they continue to add that content library, and it's so diverse. And the price point for members is so low compared to the competition that it really is a competitive advantage that is becoming harder and harder to match. And now it's actually becoming a very profitable marketing component for them that it will allow them to maybe not have to spend so much on traditional marketing to grow subscribers.